Good morning and welcome to today's webcast, Implementing Updated Lease Accounting in Healthcare. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Joelle Pulver, partner, and Carly Shannon, partner. And with that, I will turn it over to Joelle to get us started.
Thanks, Emily. We'll start with the agenda for the webinar today. We're going to start with a recap of the new accounting standard. The standard we're focusing on today will be FASB Accounting Standard Update or Accounting Standard Codification 842. GASB 87 is not specifically going to be covered in the webcast today, so if you are a GASB reporter, we won't specifically address the issues related to implementation of that standard. It was issued sort of mirroring a lot of the definitions and terms used in the FASB standard, so I think you'll find that a lot of it overlaps and gives you a good sense in terms of what the standard's asking for, but we won't specifically be addressing GASB 87 issues for today's webcast. After we go through sort of the recap of the new standard, we'll talk some about the transition guidance. We have a few examples to walk through, and then we'll go through some items to watch for or some of the things we're noticing to be issues or areas for consideration and implementation. Emily, I think we'll start with a polling question.
All right, our first polling question. Are you ready to adopt the new lease standard? And your options are yes, early adoption ready, yes, we'll be ready for 2019, or no, that's why I'm here. And if you have any difficulty seeing the polling questions today, try refreshing your browser with F5. And I'll give everyone a few moments to respond. To participate in our polls, please click the button next to the answer you choose and hit Submit. Give everyone a few more seconds. Go ahead and take a look at the results. Joelle, back to you.
Thanks, Emily. All right, well, looks like we got a lot of people here who have started dipping their toes into the standard but need more information, and hopefully we can provide that to you. If you haven't touched it yet, we'll give you hopefully a good starting point today. So as we get started, let's talk about effective dates. So for public business entities, and that's going to include those not-for-profits who have public conduit debt. So same definition that was used as a public business entity for adopting revenue recognition. For those public business entities, the standard is effective for interim and annual periods for fiscal years beginning after 12/15/2018. For all other entities, it will be with fiscal years beginning after 12/15/19 and interim periods within fiscal years beginning after 12/15/20. And then, of course, early adoption for the standard is permitted for anyone who would like to do that. There are a few exceptions, a few things that have been scoped out of the lease standard. So the standard will apply to all leases except for leases of intangible assets, leases for exploration of natural resources, oil and gas exploration, that sort of thing, leases of biological assets, leases of inventory, and leases of assets that are under construction. So all of those are scoped out, not covered by this standard that we're going to cover today. And then one other exception, probably the exception that most of you will be using or looking into, it does allow for an accounting policy election to not recognize those leases that are 12 months or less in duration. There's a few conditions attached to that. If you choose to elect this policy, you wouldn't book these leases on your balance sheet. Your lease payments would be expensed straight line over the lease term, similar to how you would currently, under existing GAAP, account for an operating lease. And just a couple of things to note about that. There's technically no exception in the standard for small ticket items, those minor items, copiers, vehicles, computers, although the standard does allow for a portfolio approach to grouping those like assets. And then also when you're considering short-term leases, you may want to think about a little bit more about even month-to-month leases. They may not be considered short-term necessarily if it's sort of economically easier or economically advantageous to you to continue to renew them month after month, therefore making it really in reality more than a 12-month lease. So just kind of think through some of those items in terms of whether or not you actually will renew for longer than 12 months before making that election. At that point, I'm going to turn it over to Charlie so he can talk through a brief recap on the standard.
All right, thanks, Joelle. I think you've already highlighted some of the areas that most people will be encountering as they adopt the new standard. There are certainly areas of judgment that are required, and we'd like to highlight a few of those today just as we go through the slides here. And the first part really kind of starts with the definition of a lease. As you can see from just the slides here, the lease contract is defined as a contract or part of a contract that conveys the right to control the use of identified asset for a stated period of time in exchange for consideration, normally cash. Included in that determination is whether there's the right to obtain substantially all the economic benefits from the use of the identified asset, and the right to direct the use of the identified asset have been transferred to the customer. So on the surface, this might seem like a really straightforward definition or new terminology, if you will, from Topic 842. But I think there's some things in here that as you look forward to adopting or you're in the process of adopting, there are some subtleties here that we need to really kind of revisit. And the first part of that is really the control aspect of the definition. The control aspect really deals with who has the right to direct the use of the asset. So from a customer or lessee standpoint, do you have the direct or the ability to direct the how and what for what purpose the asset might be used throughout the period of use? So if you think about an asset, say, for example, within the hospital, do you control how is that used? Who can access it? What are the timing for when that gets used? The mannerisms, the operators, for example, that use that asset. as the lessor able to come in and substitute other assets, for example. So that control aspect is really important when you're thinking about the definition of a lease. The standard has changed from what we call a risk and reward standard under Topic 840 to more of a control-based standard to follow along with the revenue recognition guidance under 606, which was also a control-based standard. And so it's important that those two are aligned. And so control is a very important aspect when you're thinking about the adoption of the standard. So don't overlook this. I think when you're going and starting with your adoption of the standard, it's easy to, again, to kind of skip over some of the real groundwork of the adoption of the standard, and that really is ensuring that you've identified all of your contracts that may contain a lease. So control is a big part of that. The other part of that is the identifiable asset. And, in this part, for example, the contract may not always explicitly state an asset. It may be a service-based contract, but it's implicit within that contract that there's an asset that gets used. For example, you might think about something within the organization where you have a machine that has outputs or other service or tangible things that you're really purchasing, and you view that as, well, where it's really a service, and we're really getting a service for this under the terms of this contract. But from that lessor, there's also a machine or some type of equipment that goes along with that, that although the lessor has not ascribed any value to that, or maybe didn't identify that within the contract, that supply, if you will, or that product that you're delivering or that service that you're receiving is really dependent on that asset. And so, again, it doesn't always have to be explicitly stated as a lease or an asset. You really have to look at, what you're obtaining for, if you will, from that contract. Sometimes the identifiable asset might be a physically distinct part of a larger asset. In order to be considered an identifiable asset, for example, a floor in a building might be a separately identified asset. Capacity portion of a larger asset is generally not an identified asset. So you think about a networking, internet type usage or a data service. If you're leasing, for example, or you have a contract, a service contract for 10% of a supply of a data networking capacity, that's a portion of a larger capacity. It may not be an identifiable asset. On the other hand, if you receive all the capacity in a data contract, that could be an identifiable asset because you're actually taking up the entire portion of that. So again, some very distinct areas here when you're looking at identifiable assets within the contracts. They may not always be self-evident. The other considerations here are warranty and upgrade considerations. Just because the supplier has a right to substitute assets doesn't, again, mean that there's not an identifiable asset there. Also, the supplier may have an obligation to upgrade an asset, and again, doesn't preclude the fact that you may have an identifiable asset in that. One of the other things that we talk about in terms of the identifiable asset is the right of substitution. So in the case where a lessor or a supplier could substitute another asset for you, again, that would maybe question whether or not you have control of that asset, and maybe not an identifiable asset in that case. That would only be the case if the substitution rights are considered substantive by the supplier or by the lessor. Some of that criteria relates to whether the supplier has a practical ability to substitute the asset. For example, if it requires a certain higher cost to come in and bring in a new asset, or maybe there's limitations on how the supplier may be able to do that without your permission, for example, because possibly the network, for example, or hardware storage contains healthcare type HIPAA type information, and so a supplier simply can't come in and swap out a network or some other kind of data storage for you without your consent. So if they could do that, that right would be substantive, and so you may not have an identifiable asset. The supplier would also have to be able to economically benefit from exercising its right of substitution. So, for example, if it would maybe be something that they would have a higher rate of return, for example, because of obsolescence or other things of that nature, or technology or something that's changed that landscape for the supplier. So take a look at the substitution rights in your contracts. And again, I just want to bring this up because it's really the first step in the implementation process. It does require a lot of judgment. You often hear If you've seen other webcasts or heard some folks from Moss Adams talking about this, embedded leases, this is really where this kind of comes up. You may have contracts that, again, although they don't explicitly state that you have a lease, you may have an embedded lease within that based on the criteria here that we talked about from a control and identifiable asset standpoint. So the other thing I would just take away here is to make sure that you're sharing these concepts with really everyone in the organization. It's often, occurs very often that contracts really make their way throughout the organization. They don't necessarily start and end with the accounting group or the CFO. There might be individuals from legal or treasury, procurement, especially if you're a disaggregated type organization where maybe you have hospitals in multiple states or multiple locations, or other physician groups. There could be contracts that are out in a very decentralized manner that you're not aware of from an accounting standpoint as a CFO or the controller or someone that's in charge of implementing the standard. So make sure that you're, again, really educating internally and identifying and really identifying all the contracts and then evaluating them for whether they contain a lease or not. So very important concept, and wanted just to kind of spend a few minutes on that here with you today. The next slide really just deals with lease classification. You're probably already familiar with under 840. We had capital and operating lease categories. Under 842, it'll be finance and operating. Again, as Joelle mentioned, all leases will now, substantially all leases will now go on the balance sheet as either a finance or operating lease. The main differences will be more of the expense treatment from a classification standpoint, which we'll cover in some future slides by way of examples. But I mean, that's really the takeaway, and maybe a discussion that if you've not had that with your board members or others within the organization, I think that's a real important thing for people to understand from a stakeholder perspective. From a classification standpoint, the lease classification is really determined at lease commencement date. Again, into one of two areas, either finance or operating lease, based on some criteria that you're familiar with, and we'll go over those. You don't necessarily have to reassess lease classification unless there's a modification, and that modification is not accounted for as a separate contract. You would, in some cases, reassess lease classification if there's been, for example, a change in the lease term, or whether that the assessment of, say, for example, a exercise option has changed, if you need to reassess that. But by and large, lease classification is determined at lease commencement. And then again, there's a few instances where you might go back and reassess. In terms of lease classification, really starts out with kind of, again, the four tests that we were familiar with under 840. And although the bright lines that were in 840 are no longer there under 842, the FASB did point out that those still remain good thresholds when determining whether or not you have a finance or operating lease under 840. So still a good thing to look back at, but not necessarily a bright line test in terms of classification. But as you're familiar, the primary tests are whether the lease transfers ownership of the underlying asset to the lessee at the end of the lease term. The lease grants the lessee an option to purchase the underlying asset by the lessee that it's reasonably certain to exercise. So again, think bargain purchase options. A lot of equipment leases, for example, might be a dollar out type lease, and that would generally be something that the lessee would be reasonably certain to exercise. The third one is the lease term, whether the lease term is for the major part of the remaining economic life of the underlying asset. This was kind of the 75% test, if you recall that. And then the fourth one was the present value of the sum of the lease payments and any residual value guaranteed by the lessee that is not already reflected in the lease payments, whether that equals or exceeds substantially all the fair value of the underlying asset. And that was the 90% test under topic 840. 842 did add one kind of fifth criterion, and that relates to whether the underlying asset is of such a specialized nature that is expected to have no alternative use to the lessor at the end of the lease term. So again, a very important criteria. And again, this really, I think if you have other bright line tests, you might look to this fifth one as well. That might help you kind of identify some areas where you may have a finance or operating lease. All right, looks like we're up to our next polling question.
All right, our second polling question. What does not classify a lease as a finance lease under the new guidance? And your options are A, the lease transfers ownership of the underlying asset to the lessee by the end of the lease term. B, the lease grants the lessee an option to purchase the underlying asset that the lessee is reasonably certain to exercise. C, the lease term is for the major part of the remaining economic life of the underlying asset. D, the underlying asset is of such a specialized nature that is expected to have no alternative use to the lessor at the end of the lease term. E, they all classify as a finance lease. Or F, none of them classify as a finance lease. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And we're on our second question. And let's go ahead and take a look at the results. Charlie, back to you.
All right, thank you. That's great. E is the correct answer. All right, let's go on to the next area, which is just the expense recognition pattern. Again, the lease classification, again, is always very important from both a timing into that expense recognition. Under the finance lease classification, you'll recognize a right-of-use asset, and that will be amortized on a straight line basis with interest expense on the lease liability using the effective interest method. So you get a bit of a front loading under the finance lease, whereas or compared to operating leases, it'll be over a more straight lined and systematic manner. So we'll have some examples here to go over that, but that's a difference there. To the extent that you end up with more finance leases, expect more of a front loading versus operating where it'll be straight lined over the lease term. From a financial statement impact, the finance leases would carry both a right-of-use asset and a lease liability. As I mentioned, amortization expense and interest expense will be recorded on the income statement for a finance lease, whereas from an operating standpoint, it would be a single straight line expense. From a cash flow perspective, under finance, you'll have both financing and operating for principal and interest, and then under an operating lease, you'll have simply operating lease payments. So that's kind of a difference there. I think if you end up from a classification point, or if you have covenants, for example, that are based on EBITDA, again, classification could matter to you. Under the finance lease, you're going to end up with more amortization and interest expense, which will actually improve your EBITDA calculations, for example. But that's some differences that you could see from classification. I think the other thing I want to just point out here, mention very briefly, is that the FASB made it clear that the lease liability is not debt, but just rather another operating liability. So if you've not had those conversations with your lenders in terms of what this lease liability will look like under both a finance or an operating lease, it would be important to do so. Just know sometimes covenants contain some really rigorous requirements from debt covenant ratios and things of that nature. So again, just having those conversations with your lender about what the lease liabilities will look like and how the FASB consider this from that standpoint. All right, I just want to talk a little bit now about transition guidance. On adoption, the Leases standard, both lessees and lessors are required to use a modified retrospective transition approach. That would be applied at the beginning of the earliest comparative period presented in the financial statements or the application date, as well as for leases entered into after that. And the modified transition approach really allows lessees to leverage the information that they have under Topic 840 today and really wind down. In my mind, it really helps you kind of wind down some of the leases that you currently have during the transition period, because you currently should have some of that information, maybe that you're already disclosing, for example, for both capital and or operating leases in your 5-year tables and your footnotes. And it also allows you to really carry forward some of the existing leases for the remainder of their terms, assuming there's not a reassessment or something of that nature. And again, from a standpoint, if you think about your 5-year minimum lease table in your financial statements, again, an operating lease liability would be recorded, based on that minimum lease payments that you're probably already presenting today, and you would also have obviously a corresponding lease liability. To the extent you have any capital leases today, generally you can just carry those balances forward for those amounts based on the obligation that's outstanding in the immediately preceding period prior to the application date. So again, it's important to remember that leases entered into on or after the effective date of Topic 842 should always be accounted for under the new guidance, and any leases that have ended before the initial application period would generally not require any transition efforts. So we're really talking about those leases that are kind of still hanging out there during the transition period. To kind of help with that, the FASB has granted some practical expedients or transition relief, and one of those is referred to as the package of 3 expedients, if you will, and it allows the lessee to not reassess the following conditions, and those are when an entity, or rather an entity need not reassess whether any expired or existing contracts are or contain a lease, and also permits an entity not to reassess the lease classification for any expired or existing leases. And then finally, an entity need not reassess the initial direct costs for any existing leases. So in order to apply the practical expedients, you have to elect them as a group, and they must be applied to all leases upon adoption. And then I think another important thing to remember, if you have possibly not identified leases in the past, those would have to be identified. You can't apply the guidance to leases that that you had not properly identified, I guess, under 840. So keep that in mind as you go through the transition process. Okay, the other practical expedient that the FASB provided really related to the use of hindsight in determining the lease term. So, and when assessing impairment. So again, it allows you to use hindsight in terms of looking at the lease term from a lessee perspective, and it provides you with an additional method where an entity initially applies the new lease standard at adoption would also recognize a cumulative effect adjustment in your opening balance to retained earnings. So again, some notable relief here, if you will, from a practical expedient standpoint. The last one also relates to land easements. So I'm not sure how many of those are there in healthcare. From a healthcare perspective, to the extent you have those, definitely some relief there where it doesn't require you to go back and reassess your land easements. You can continue to account for those as you have, and once those renew or modified, then you would account for them under the new guidance. So certainly some relief from that standpoint. Also want to just point out one other notable information from the SEC, and realize, again, not necessarily whether or not you're an issue or not, but I think it's helpful. And we're glad to see that the SEC actually commented on this as the public companies were trying to go through this or getting ready to go through this. They noted there was some diversity in practice in terms of whether registrants or issuers were including executory costs and their minimum rental payments for the operating footnote disclosures. And so just given that diversity of the staff, so they would not object to maintaining your current policy, whether you include those executory costs when calculating your 5-year minimum rental payments or lease payments in your table. So as you look forward to transition either as a public business entity or a private company, and you may have had a policy of including or excluding those executory costs, consistent with the SEC comments or guidance here, you can either maintain your current policy or make an accounting policy election or to include those going forward. The same also related to variable lease rates. Again, the staff noted some diversity in practice in terms of how variable rates were included in the minimum lease payments. Again, there was some diversity whether issuers or registrants were including the indexer rate that was in effect at the beginning of the lease period or the lease inception versus the earliest period presented. And again, just remaining consistent to your current practice is kind of what the SEC staff has said. So just being consistent, I think you'll see from a Moss Adams perspective, will probably likely be consistent with the SEC staff on those, and I think that's an invaluable insight from the SEC, even though some of you largely probably are not public companies. But again, I think I generally find these things very helpful. If you want to change your policy, you'd have to look to topic 250, which relates to changes in the application of GAAP, and so I'll also keep that in mind as well. Okay, to the next polling question.
Okay, our third polling question. Do you have a contract review process in place to identify the lease information you will need for accounting and compliance? And your options are yes, no or I don't know. And for those of you that would like a copy of today's slide deck, you can download that now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. I'll give everyone a few more seconds here. And let's take a look at the results. Charlie, back to you.
All right, thank you. That's great to see that. I think that's a great starting point. And with 52% of you that have a review process in place, I think, again, with the new standard or with really implementing any new standard, it's a good time to really revisit your internal controls, especially over the standard or, for example, reviewing contracts. And knowing that you have a process in place, I think really helps you put you in a good position to have an effective implementation of the standard. So kudos to you that are in that 52%. If you don't, I think this is a good time again to really look at your internal controls and processes right now and say how can we really change that going forward to ensure that both for existing contracts to ensure we have a complete population of all the contracts that are out there which may or may not contain a lease, as well as any new contracts that might be executed, after this date. So great result there, and again, just a good reminder in terms of the challenges that will kind of go along with the standard. Kind of in the next series of slides, just wanted to highlight a few of the areas under 842 that, in my mind, just really kind of revolve around a higher degree of judgment from the standard standpoint. So we won't be able to take a really deep dive into all of these just given our time frame, but I think if you were to go back and look at, again, thinking from the beginning of really do contracts, do you have a lease or not a lease, and really scope more of the scoping question. These are, outside of that, some other areas that require judgment, and I think you'll want to go back and really revisit the standard and make sure you understand what's required. And those relate to non-lease components, the lease term, calculating lease payments, the discount rate, and then lease incentives and modifications. So I'd like to go through a few of those with you. The non-lease components, again, from a standard standpoint, you really started with, when you're going from a measurement standpoint, part of it is really start by identifying the lease components, and then you also need to identify any non-lease components, and then measure the consideration in the contract, and then allocate that consideration in the contract to both lease and non-lease components. So when you think about a lease component can be a lease or a bundle of leases. For example, if you have a master lease agreement, and you might need to account for those either as a single lease or a bundle of leases, and that would be based on whether that singular lease or bundle of leases would benefit the lessee either on its own or together with other resources that are really readily available to you. The other kind of lease component, if you will, that comes up often here or that you need to consider rather is land. So oftentimes you might have a building lease which might also include land that might also need to be separated from that standpoint. In terms of the land lease, you have to really look at that in terms of whether that would be significant to you and whether that would have a change in classification from a measurement standpoint, from a classification standpoint, if you included the land within the lease or lease classification test, or you excluded that. So you think about a single or multi-type tenant arrangement, and so keep those things in mind if you're looking at. Generally, if you're in a single tenant arrangement, that land lease part of that component might be significant to you or may not be insignificant. Generally, if you're in a multi-tenant facility, the land is probably insignificant and wouldn't change lease classification. So that might be another component, if you will. So once you've identified the lease and non-lease components, then you kind of allocate that price to the lease and non-lease components, either based on, as a starting point, the observable standalone prices. And then if observable standalone prices are not available, you're able to estimate those prices from either looking at market information, doing a cost-based approach, or a residual approach. One of the practical expedients that the FASB also provided to us was that you can make an accounting policy election to not separate lease and non-lease components and account for it as a single component. That will have the effect of grossing up, if you will, the right of use asset and lease liability. So keep that in mind if you make that election. And again, don't have a lot of time to go into this today, but from a standpoint of looking or determining the non-lease components, there are a number of things there that you need to really look at, especially under the residual approach and deciding which are lease or non-lease components. And one of the kind of things to think about from a non-lease component is whether there's a transfer of good or service. And if that's not there, then it would be a non-lease component. So keep those things in mind as you go and look at your lease and non-lease components within your contracts. Okay, lease term. We get a lot of questions around this, and Joelle mentioned kind of the short-term lease exception, and I think it's really, again, important to kind of go back and look at the standard. The lease term really is the non-cancelable period, plus any periods that are covered by the lessee's option to purchase or extend or terminate the lease when it's reasonably certain, or any lessor options to extend or not terminate the lease, so things that would be within the lessor's control. And so that would kind of create your lease term. And again, highlighted here just the fact that the reasonably certain is a very high threshold. It's very comparable to reasonably assured. And that threshold is really higher than probable. So you think about 75% from a reasonably assured standpoint. So that is very much an area of judgment when you look at renewals and other contract considerations. And how might you decide whether or not it's reasonably assured? Some things that you might think about are looking at the contract. For example, does it have a penalty for failure to renew? Is the asset critical to your operations? If you have, a surgical center or some ICU or something that you've expanded at the hospital, and that's really critical to have that component for maybe you're an outpatient care facility or, again, a multi-physician type practice, if that asset is critical to you, and it's likely that you're going to renew that versus going down and purchasing something new because it's just the impediment to getting some new asset in there, then you might assume that renewal period has a high, reasonably certain threshold of getting renewed. Other market-based factors as well could have an impact on that. So again, looking at that threshold and really determining, again, whether it's reasonably certain. And this is one of the questions we often get on the short-term lease exemption. And again, the short-term lease exemption is really based on the lease period, the non-cancelable lease term or period that's at lease commencement. So often we'll get questions that say, well, we have a 5-year lease and we have 6 months left. Is that a short-term lease? No, that's not a short-term lease. That's still a 5-year term lease that you'd have to evaluate for classification. So it is the non-cancelable period at lease commencement. And so be thinking about that from a short-term lease exemption, as well as, again, your likelihood to renew. If you have, for example, an auto lease or some other equipment lease that your past pattern indicates that, or just for economic reasons, you're likely to renew that lease every year because, again, it's critical to you. Even though the term may only be 12 months, if you have a renewal option and it's reasonably certain that you're going to renew it, may not qualify under the short-term lease exemption. So when you have those areas of judgment, again, like all of these, make sure that you're talking internally as a team, you're making some decisions, and you're documenting your rationale. And then always, as it's important to do, make sure you're talking to your auditors as well. In terms of the lease payments, a little bit more straightforward on this piece. The fixed payments, lease payments to be calculated as any fixed payments less incentives paid or payable to the lessee, any exercise price of any options, any penalty payments, for example, for things that may not renew, any residual value guarantees that are probable, as well as any variable payments that are based on an index or a rate. And that index or rate would be based on those at lease commencement. So again, keep that in mind from a standpoint of the lease classification and measurement test, very critical from that standpoint. You often see, again, other things like in-substance fixed lease payments. Those would be included. Again, really looking at the options and renewal. This goes hand in hand with the term. If you've made a decision that you're reasonably certain to renew the lease, if there's cost to do that, you would include those in your payments as well. So, or either termination penalties, for example, as well. So keep those in mind as you go through and look at your lease payments. All right, the other area is kind of your discount rate. So once you've determined both lease classification, your term, you've calculated your lease payments, and you also need to look at how you'll measure, both for classification and measurement, which discount rates you're going to use. The discount would be, again, the rate that's implicit in the lease if it's known to you. And this concept is really not intended for you to go out and do a lot of legwork or really expend an ordinary amount of effort to determine what the actual rate implicit in the lease is. And oftentimes that'll be very difficult for you to determine because based on both the fair value of the asset as well as the lessor's incremental direct costs, which may or may not be known to you. So oftentimes it's very challenging to get that information. So where a lot of lessees end up then is using the incremental borrowing rate. And that also has its challenges, and there's some areas of judgment as well here. The incremental borrowing rate rather is the rate that would be based on kind of a collateralized borrowing rate for you as a lessee, and that's a difference into the old standard, where the old standard, the discount rate was really based on the rate that would be similar to purchasing an asset. The incremental borrowing rate under the new standard is really a rate that's based on the rate of interest that a lessee would have to pay to borrow on a collateralized basis for a similar lease asset and a similar term. And those kind of criteria are important because you need to make sure that your incremental borrowing rate really does approximate both the nature of the underlying lease asset as well as the lease term, to the extent there might be differences in the lease term, both from a renewal standpoint. So maybe, again, your lease term is 5 years, but there are going to be renewal options, and it's reasonably certain that you're going to renew, say, for 10 years. So your incremental borrowing rate should also follow kind of that 10-year lease term when you're thinking about the rate that it might be required from a borrowing standpoint. You also need to consider other kind of payment options if your lease rates are payments in advance, or if they're bulleted rates or balloon payments. Those are all things that can affect your incremental borrowing rate. So a lot of things to consider here. This has probably gotten a lot of more questions than some might anticipate. And so there is an option to use a risk-free rate for non-public entities. So again, a little bit of relief there on that side. So not sure what others will pick in terms of that size. I've seen the case for both, but certainly the risk-free rate is an easy way to go. But if you can calculate your incremental borrowing rate, sometimes that rate might be a better rate. If it's a higher rate, for example, it would result in a lower lease liability. So again, something to consider as you're really evaluating your incremental borrowing rate. Again, the key thing here is really to have good documentation about how you determine that and how that incremental borrowing rate really closely resembles both the lease term and the nature of the leased asset for collateral purposes. All right, lease incentives, just a couple of points here just in terms of, really I think the main thing or main takeaway here is that oftentimes you see, especially with real estate leases, there are a number of either rent holidays or payments that are made to or on behalf of the lessee, either prior to or at commencement. And these lease incentives, if you will, really serve to or should be calculated to reduce the right of use asset and the lease liability. And so that's how they're reflected. Also need to have careful consideration of any leasehold improvement allowances and determine whether those are actually to the benefit of the lessee or the lessor and how those might be treated from a lease incentive standpoint. So there's some judgment areas there in terms of tenant allowances and who will really benefit from those things and really what is bearing the cost, if you will, of those leasehold incentive initiatives. So with that, Joel, I'll turn it over to you to talk about some of the qualitative disclosure requirements and go over some of the examples that we have.
Perfect. Thanks, Charlie. I think no surprise here, as with most new standards that are adopted, there's just quite a bit of additional disclosure that's going to come with this. And you'll see as we go through some of these qualitative disclosure requirements, they really mirror a lot of the topics that Charlie has brought up. You can kind of count on the fact that if you had to use significant judgment or had to document your significant judgments in coming up with a conclusion for adopting the standard, that likely they're going to want you to disclose those those judgments you used. So just kind of working through this list of the qualitative, there are some quantitative disclosures that exist as well. But you're going to have a general description of your leases, as well as listing out the terms and conditions for options to extend or terminate those leases. To the extent you have any residual value guarantees, those will have to be disclosed. If there's any restrictions or covenants imposed by the leases, those will need to be included. And then the basis, terms, and conditions on which you determined your variable lease payments. And then also sort of those leases that are not commenced. So one of the things Charlie's been talking about is that all of this analysis is based off of, and you do this analysis based on the commencement date of the lease, so when the asset is made available to the lessee for use. So there could be some that have been initiated as of your balance sheet date but have not yet commenced. And so anything that's in between that period would also need to be disclosed there. And then a little bit deeper into a couple of these different things, you're going to want to disclose information about your significant assumptions and judgments. And this is not a comprehensive list, but that includes your determination of whether a contract contains a lease. So if it's a contract that doesn't seem naturally to have a lease in it, sort of your consideration of whether or not there's a lease within there. Any allocation of the consideration between the lease and the non-lease components, and then determination of your lease discount rate. And as Charlie mentioned, this is really one of the significant items we're finding that can be difficult to get to, either the lessor's implicit interest rate or your what you use to come up with your discount rate based on a collateralized rate of borrowing. And Charlie mentioned this, but that allocation between lease and non-lease components, this disclosure will have to include a description of the method you use to determine the standalone prices of the lease and non-lease components. So I think we're going to go to a polling question real quick.
All right, our final poll. Which is not an example of a non-lease component? And your options are A, common area maintenance, B, janitorial, C, rent holidays, D, service and support, E, supplies, consumables, and disposables, F, equipment operators. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE Progress widget to the right of the slide view. And I'll give you a couple more seconds. And let's take a look at the results. Joelle, back to you.
Perfect, thank you. So C is the correct answer. Rent holidays are really captured as part of the initial and subsequent measurement of the lease liability and the right to use asset. So it's a factor into calculating that present value of the future minimum lease payments as opposed to a non-lease component. So with that, I'm going to head into a couple of examples. We're going to start with a finance lease example. So here's kind of just our base facts. We have a 3-year lease term, and the lease payments are made in arrears, $100,000 in year 1, $110,000 in year 2, and $125,000 in year 3. And the client has determined the discount rate to be 5.51%. So if you take the present value of those 3 years worth of lease payments at that discount rate, you would end up with a present value of $300,000, which is what you use here to come up with the initial journal entries. So we have to book the right to use asset and the lease liability at the lease commencement date. So that's the $300,000, which is the present value of those minimum lease payments. So we create the right to use asset and the lease liability there at the lease commencement date. And then during that, we sort of are assuming booking one journal entry to recognize each of the lease expense components for the year. But entry 2 is to recognize your interest expense, which would be the $300,000, so the minimum the lease liability amount times your interest rate of 5.51%. So interest expense of $16,535, and then the other side of that goes to your lease liability. And then we have amortization expense, so amortizing that right-to-use asset over the 3-year life of it, so $100,000. And then we also are reducing the lease liability by the actual payment made of $100,000 for the year. So if we then take that and move it forward into year 2, it gets a little bit more complicated just to come up with the numbers, but the same journal entries. So we have interest expense in year 2 of $11,935. And so how we got that was the original lease liability of $300,000 minus the $100,000 payment that was made in year 1, plus that interest expense we calculated for year 1, and then multiply that by our interest rate of 5.51%, gets us to the $11,935. And then the amortization entry is the same as in year 1, the $100,000. And then the reduction of the lease liability is equal to that second year payment of $110,000. And then similarly in year 3, we're going to do the same thing. To calculate the interest expense, we take the original liability of $300,000, we subtract out the 2 payments that have been made for $100,000 and $110,000, and add in the 2 prior years' interests of $16,535 and $11,935, and multiply by the interest rate. And that gets you to $6,530 of interest expense for year 3. And then again, the $100,000 of interest of amortization and the reduction of the lease liability by the $125,000 payment. So that's what it would look like for a financing lease or finance lease. Kind of just looking at a summary of the balance sheet, income statement, and cash flow for you so you can see what that looks like. At the end of year 1, you would have a right-to-use asset of $200,000 and a lease liability of $216,000. It shows you there the components of expense broken out between interest and amortization. And then as Charlie mentioned before, in the cash flow statement, the principal payments on the liability goes down in financing versus the interest piece of it goes up in operating cash flows. So our second example is going to walk through the operating lease example. So same facts here, 3-year lease term, same payments per year, discount rate of 5.51%. So just like we had mentioned earlier, the balance sheet will look the same under both a finance lease and an operating lease. So we have a right-to-use asset of $300,000 again here with the lease liability of $300,000. And then the standard calls for one lease expense line item, but we find it easier to sort of break that apart into the 2 components that make up that lease expense. So if you kind of look off to the right-hand side of the slide, you can see there that the lease expense, which in total is $111,667, there's 2 components of that. The first is the interest, which is the $300,000 times 5.51%, and then the difference there is the amortization, and we call that a plug because in the operating lease example, the lease expense is straight-lined, just like current GAAP. So total payments on this are the $335, and so we took the $335 total payments on the life of this lease and divided by 3, which got you to the total lease expense per year. It'll be the same for each year. And then you're just calculating there, or we calculated there for ease, sort of how much of that was interest and how much of it was amortization to get to that one line item. And then the reduction of the lease liability is the $100,000 payment less the piece that was interest. And then you reduce the right-to-use asset by the 1/3 of the total payments less the interest to get to your cash outflow of $100,000 for the first year. So there's a little bit more math sort of involved in doing this, but at the end of the day, your balance sheet is going to be the same at the inception or at the commencement of the lease on both scenarios. And then here in the example, we just carry that math forward into year 2, just one journal entry there, same lease expense, that's 1/3 of the total lease payments. The lease liability is the difference between the cash outflow and the amount that is the interest expense. And then you see there the cash and the reduction of the right-to-use asset. And same thing for year 3, just the payments really being different in the allocation. And then here we have the high-level components of the balance sheet, income statement, and cash flow. So as of lease commencement date, the balance sheet was the same between finance and operating lease, but you can see as of the end of year 1, there is a difference in the balance sheet and income statement, or in the balance sheet between the 2 lease options. And then you'll see there in bold we say total single lease expense. That's what you would actually show on your income statement, just that one line item. And then we have above there the 2 pieces we broke it out for ease of calculation. And then on the cash flow statement, all the cash flow impact is through operations. It's operating cash flow changes. And then finally, we have just a quick, I'll go quickly through this one so we can leave a little bit of time for questions. The transition of an existing operating lease. You can see there we've got 4-year term, and we're adopting in year 3. The payments are equal, discount rate is 6%, and this particular lessee adopted the package of practical expedients. So they're going to account for it without reassessing whether the classification should be different. So as of the year of adoption, for the first 2 years here, this is pre-adoption. This is just the lease expense and cash. This is what you would have recorded under Legacy GAAP or Topic 840. And then here at the inception or the adoption date, you have the right-to-use asset, which is the present value of the 2 remaining lease payments. And then in that same year, you have your lease expense for the straight line of the 2 remaining payments, with the lease liability calculated as the payment less the interest, and then the cash going out the door. And then the same calculation again for year 4. So we wanted to sort of wrap up with what should you be doing now? I think Charlie mentioned probably the main thing to really focus on and look at is how do we get a complete list of all of our contracts that may contain or do contain leases, and how do we make sure that we're accumulating that list, tracking those contracts, and that we're identifying those items that we need to factor in to understand the transition. A lot of clients, a lot of prospects we're talking to are forming a lease implementation group, which would include a cross-section of folks across your organization. Come up with that inventory and then start talking with your auditors to make sure that you are able to provide the information they'll need to help audit your adoption as well. I think with that, we are almost out of time, so I think, Emily, we might have 1 or 2 questions we can address.
Yep, we are right at the top of the hour. If you have questions for our presenters, you can enter those in the Q&A box right beneath the slide view, or you may reach out to them directly. You can probably squeeze in 1 question. If we don't have time for your question, we will do our best to follow up with you after the webcast. Let's see here. Does the use of software generally qualify as lease?
Joelle, I guess I'll respond to that one. Generally, the software or use of internal use software would be an intangible asset, so that would be outside the scope of Topic 842. You could also maybe look at other things. Again, if you think about the contract and really what are you gaining access to, is there an identifiable asset or something else outside of the software? That might be one of the lease components or non-lease components, but generally just a straight software lease would fall outside the guidance.
Thank you. And we probably can squeeze in 1 more here. How to determine MLP if we have an option to, but asset at FV option?
I'm not sure if I quite understood that, but it might be related to purchase options. So if you have a purchase option that's reasonably assured, or again, even a termination penalty that's reasonably assured, you would include those in your calculation of the minimum lease payments at that present value that we talked about using your incremental borrowing rate or the rate implicit in the lease. So those will be part of your calculation of the minimum present value of the lease payments. So that would be included in that calculation based on, again, if it's reasonably assured. So it would have to be, somewhat of either a bargain or something else like that. But again, it may or may not be a bargain. It may be something that, due to its the nature of the importance to the organization or the hospital, for example, that, again, you're reasonably assured of doing that. So you would include those purchase options in your minimum and your lease payments.
All right, thank you for that. I believe we are out of time for questions. Again, if you think of something, please feel free to reach out directly to Joelle or Charlie. You can also still submit questions in the Q&A window, and we will do our best to follow up with you. Thank you, Joelle and Charlie, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts folder to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.